Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Greg Dickerson. And we've got to talk about tech layoffs and specifically tech layoffs and what might happen to Bay Area housing and other cities that are very tech heavy. How you doing, Mr. Greg Dickerson?
Hey, doing great. Good to see you, Mike.
I don't know if you've seen, you probably have, but I don't want to assume there was some big layoffs at Twitter on Friday. On Sunday, Wall Street Journal put out an article that Meta could see up to 10% announced on Wednesday. I've done a video over the weekend saying there's a lot more coming. The All In podcast is basically saying, more layoffs coming, and they have to come to really get to cash flow positive profitability. And I go back to thinking about the dot-com crash because I was an executive at that time and had to make these painful cuts. And then I remember housing. And I remember what happened in Bay Area housing. And I also remember what happened in Fresno, which is a market I invest in. And one of them was rough and the other one didn't skip a beat. So I guess we'll talk about tech layoffs first, finance layoffs. Have those kind of hit your radar? And what do you think's going on?
Yeah, absolutely. So it's the white collar jobs, obviously in Wall Street and tech companies that are getting the cut first. And what's happened there, the liquidity cycle's changed, the business cycle's changed. So the last 2 years of, go fast and break things and money's free and available and everybody's throwing hundreds of millions of dollars at these companies that aren't earning any money, don't have to make a profit because everybody's looking for this exponential growth down the road, a la Kathy Wood's portfolio. We don't care if you're not profitable today. It's all about users, active daily users, engagement, advertisers, subscribers, those types of things, and body count. So what drove the value in these tech companies were not only active daily users and subscribers and all that, but body count. How many employees do you have? So it all of a sudden became a sign of value. You're a valuable company if you've got all these employees and you're hiring, because that shows growth. Problem is, nobody had to worry about the bottom line because money was free. So it didn't matter. And everybody was investing, everybody was throwing money at the allocators and equity funds and all that. So they're all just throwing money at them. Now the switch has been flipped, right? So the liquidity is drying up, interest rates have gone through the roof. So it's no longer the same value proposition as it was, and your delta is much more difficult. If you're, having to, earn yield, or make a profit, it's not going to work now with the interest rates that it's costing you to invest in these companies. So now it's the other way around. Now you're more valuable. Like Meta, you're going to see a pop in Meta because they are laying off. They're
Oh,
getting
absolutely.
their balance sheet in shape, their P&L in shape, and they're starting to act like a big boy company now and an adult company and
Right.
monitoring the bottom line and becoming profitable. The profitless tech is probably going to be gone, because there's no capital flowing into those because capital has to make a return now, especially when you have investors going, wait a minute, I can throw, my money and get a risk-free return in bonds at 4.5%. Why go risk it over here when we're heading into a recession and, things like that. So it's
Yeah, I just
all
checked.
business cycles.
No, I totally agree. And the beauty of our conversations that people can go back and watch is we've been talking about this is coming. It's just happening in real time. Hopefully, I mean, you and I had many conversations on how to prepare for this. So hopefully people took action and they're ready for this. I will say, um, like if you are unfortunately one of these folks at Meta or Twitter that were just laid off, I actually have good news for you. uh, the first sets of folks to get laid off, it'll be relatively easy for you to find a job. What you don't want to be is somebody that's laid off in 9 or 10 months after most of the tech companies have already taken the pain, because then we'll be at kind of the depth of the cycle and it will be hard to find a job. So I know how it feels today. Hopefully you got a good, severance package and, stock purchase plan and options and all of that. So you're fine. I have to tell you to be relatively easy to find a job today. It won't in 9 months. But yeah, this is just beginning, I think.
Yeah, and it's a healthy thing because these companies were overstaffed. They had redundant positions. They were very inefficient. Not to say that the people weren't good at what they were doing. It's just that they had too many people, and the people leaving will probably tell you that. Hey, we had too
Mm-hmm.
many people working there.
Mm-hmm.
So hopefully, what will happen is this will bring the job market back into balance
Yep.
and help start reducing a little bit of inflation. Because that's your biggest issue right now. There's still twice as many jobs as there are people willing to take them. I don't know where all those jobs are, mostly in the
It's
service sector,
yes,
service industry
service.
a lot, construction,
Mm-hmm.
those types of things. But when it comes to, white collar, I don't know if that exists because
Mm-hmm.
Wall Street's laying off, tech companies are laying off. there's some other companies coming up, but they don't have the capital to hire anymore. And it's no longer fashionable to just bring bodies on at mass and show all these hirings ahead of growth, which is what you really should be doing. You should always hire ahead of growth, but now you have to be careful about it. You have to do it smart. You can't just throw people in and say, hey, we got 10,000 employees. Well, we only had 5,000 yesterday. We're worth a lot of money. Doesn't work like that
exactly.
anymore.
No, and then let's bring this to housing, right? So again, I think this is coming. I think Facebook and Twitter are the first of many to come. This will impact the Bay Area housing because the Bay Area, the Silicon Valley specifically, it's a rather small footprint. And, your network doesn't have to be very big for you to know someone that was impacted. So what is going to happen very quickly, if it's not already happening, is people are going to back away from big expenditures. And in the Bay Area, there's nothing bigger than a purchase of a home, right? The median home price in many Bay Area cities is over $1 million. And we're not talking big homes. We're talking 1950s shacks. So there's going to be a lot less housing transactions. And unfortunately, there will be people that purchased recently that need to sell because, hey, they got a job, but it's in Texas, or they got a job, but it's in Nashville, right? I think we're going to see more people find jobs out of the Bay Area. Because I think tech it's just cheaper elsewhere. And one of the things the pandemic proved is you can build tech companies in Austin, Texas. You can have tech in Miami. So I think a lot of the cuts are going to come to Silicon Valley because it's just too expensive. And I think
Phoenix, Phoenix is a huge tech area,
True.
And housing is getting real cheap there. So, people will leave these expensive areas and go to these other areas where their dollar goes a lot further. And, some people will stay, but at the end of the day, some of the salaries that people have been getting in the tech world, $200,000, $300,000, $400,000 for mid-level, type developer positions, project manager positions, tech positions, that's going away. You're going to see that change. And when somebody's, salary is eliminated, they've got a little bit of severance and things like that. They start thinking about that payment that they're making on that house and then the cost of living there. And then already a lot of people leaving those areas anyways, just because of, safety and crime and things like that, that's out of control in a lot of these cities, is driving people out anyways. But it'll be interesting. Is it something that's going to affect the real estate market at scale as a whole? Probably not.
No.
There's almost nothing out there right now that's going to do that because there's so much distortion in the market, and there has been, for the housing crash, to happen. And like I said, we can see a 30% drop in the median home price, and we're just back to where we were before the pandemic at a normal level. So that's not even a crash.
Yeah. I think the Bay Area is in for some pain. I think it starts here. In the Bay Area, again, as a footprint is rather small, and it's amazing to watch. It's the psychology flip, right? For the last roughly 14 years, it's been go, 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 hire at any cost, spend money like it's water. And what's going to happen very quickly, and could happen as soon as Christmas, if not by Valentine's Day, you're going to see the psychology in the Silicon Valley change. People will go from, buying another car, buying another crazy vacation, to not doing those things. And that is going to have a surprising impact because, again, like you said, it is not uncommon to make 200 grand in the Bay Area. It's not uncommon, like your total comp package.
Yeah, that's probably cheap. I think it's more around 3.
Yeah. And again, if you add a couple together, that's $500,000, a husband and wife combination. But again, with the crazy price, it's just going to be, I've been here before. I have seen the Silicon Valley change from money is water and free to I'm going to hold on to everything. I think we're on the cusp of that flip. I think Twitter is a start. Meta's next. I think we get another big one, and people will start retrenching, and that will have ripple effects on services and cars and things of that nature. But I think nothing will feel it more than Bay Area housing. I think Bay Area housing is in trouble.
Well, but I think the bigger impact is the commercial. So they're already reducing their footprint in, office space. So I think that's taking
Market
a biggest
Street
hit.
Vacant.
Yeah, that's taking a big hit right now already. So I think that's your biggest impact. Housing will be next, but again, there's still so much demand. Once prices drop, people will snap those up. So I'm not sure it'll destroy the market there. Will it affect it like we're seeing and correct it like we're seeing? Sure. But, are we talking about a crash? When you think of crash in the terms of like a 2009 scale where property values went down, again, the big thing about the crash bros, is that they're calling a crash from a very distorted level. So again, you can drop 30%, to 50% in some markets, and you're back to where we were before the pandemic started, before
Yeah.
the 2% interest rates, and we had that huge run up. And that was, coming off of a, artificially higher level. So to have a housing crash now in relative terms, you would need to see values drop like 60, 70% to
Yeah, that's
get
not
to where you could really call it a crash.
not happening. Yeah, not happening. So again, I think there is getting some pain coming to Silicon Valley, but really the point of this for most viewers is if you're not in the Bay Area or maybe some other very tech concentrated markets, you won't feel it, right? Again, the dot-com era, I lived through it. We actually bought a home in it, and it didn't impact Fresno at all. And Fresno's 2.5 hours away, right? Oh, we
Yeah.
don't got any tech. They didn't skip a beat, right? So again, I
And
think
again,
most of
this
the
is business
country won't
cycles
know.
and temporary, and it'll all come around. And once the dust settles and we get all this under control, it's going to be off to the races again. And that's what I'm excited about and waiting for.
Yeah, I can tell. Maybe we'll do a video on that about. Yeah, I think we have time, so we'll do a fourth video. Greg, before we do that, where can people follow you?
GregDickerson.com.
Awesome. Thank you so much.